Now two is not enough.
Hey guys, what's up? Welcome back to Investing 101. Today we'll be going in depth to stocks, what they mean, not really how to invest in them, but what do they mean, reasons why you should invest into them, and as well as some risks in investing in them. So with this course, before we begin, I'd like to say that I'm going to have a few links in the description, but any information that I thought was helpful when I was doing research about this, as well as a few books I recommend getting, um, just to improve your knowledge about stocks or improve your knowledge about the theory of stocks and stuff like that. So let's get started. What is a stock? So stocks are an investment in a company and that company's profits. Investors buy stock to earn a return on their investment. Basically, what they're saying is, what it says is that you're putting money in to a company and waiting for the company to grow so you can get your money back or more money than what you paid for. So in most cases, you are buying a part of the company. That is probably most people's understanding if you're anywhere or if you know anything about stocks. And these securities meaning assets or whatever helps you get money, securities represent ownership shares in a company. This is true for common stock. It's not true for all stock, but for most stocks it is true. So investors invest money to make a profit, of course. That's the whole point of putting money in something, is to invest or save it up for something bigger in the future. Companies issue stocks though to raise money. They want to have investors come on board and make sure and give them money so they can improve their product line, create new products, maybe even do a little bit management, expanding their business, maybe like going to a different location. All of those they need money for, and a lot of times it doesn't come from uh, their own pockets. It's like if you ever watch Shark Tank, which I highly recommend. Please watch Shark Tank, learn more about anything money related. But Shark Tank, what they do is entrepreneurs will go in and ask for money, and so they can improve their inventory, product line, product in general, create new products, expand to a different location, anything like that. So public companies sell stock through a stock market exchange. So you probably heard of the NYSE, the New York Stock Exchange. Uh, Really big thing. Wall Street, that's where that is, that whole thing. NASDAQ, NASDAQ, National Association of Securities Dealers Automated Quotations. They're basically two stock market exchanges. There is a lot more in the world. Usually there's one for each big city like New York. There's a Shanghai Stock Exchange. There's a London Stock Exchange. You can invest in any of them, but most people prefer that you invest in the country that you're living in. So, reasons to invest in stocks. It doesn't take too much money to begin. I'll explain that a little bit later in different types of stocks, but it really does not take too much money to begin. Uh, Anytime if you're going to buy a latte, right? Instead of buying that latte, take that money and put it into a savings account so you can build up your money, and hopefully you can invest it in those like big stocks like Apple, Amazon. Those are like Apple costs $245 a share, but you want to buy more shares so you make the most money as possible. Amazon, on the other hand, costs $1,000 per share. So you want to save up your money and buy those high level stocks that can increase your profits by a lot. So stocks can pay dividends. In my last video, I explained what dividends are, but dividends are basically income you get from the company when you invest in them. Not all stocks do this, but some stocks do. You don't have to be a brainiac to invest. People think this only the smartest people. Everybody thinks that you have to be Warren Buffett to invest in stocks, but you really don't. Anybody can invest. All you have to have is some background knowledge about how a market works, how to use stocks and how to invest in them in the first place. And as you get deeper and deeper into it, you'll pick up knowledge as you go. It comes with experience, like most things do. Um, you can grow your wealth by a lot. people don't invest. One of the reasons people don't invest is there are risks. Everything has a risk in it. Everything has a risk involved. But the thing with stocks is that this is a stat I pulled up, but the stock market has averaged a 10% annual return since 1926. 1926 was around where when the Great Depression happened and markets closed down, stocks plummeted, everything bad happened in the economy. But it's been averaging 10% annual return since 1926. Although this may not seem a lot, everybody's going to lose some money eventually. No company is going to keep rising in stock prices over and over again, or it just wouldn't make sense. That's not how the world works. So, but people are able to be smart, and with experience, it comes with experience. People are able to use their skills and their abilities to invest in the right stocks at the right times. Stock prices do appreciate. Appreciating means it will go up. All companies, it will go up eventually, but you don't want to wait for that. You want to invest in the right stocks to go up that certain amount that you want to hit, and then take it out and invest in something else. The market does not know your plans. Investing success is straightforward. What I mean by this is that the market does not know what you want, what you're gonna invest in. So they can't like a person can't um, make that company go down or do that if it just because you're in it. I mean, maybe that could happen, but that's like really a chance of that happening is really low in general. But like in general, somebody or a market can't make sure that and whenever you invest in stocks, it will always plummet. That's not the same case as in some jobs. So there's that too. There's no need to rush investing. You can invest short term. You can invest long term. Long term would be bonds, even long term stocks. I'll go into more about blue chip stocks, but blue chip stocks you can invest in long term. They stay pretty stable, and you get good profit out of them. But there's no need to rush investing in general because you want to learn as much as possible, and you want to make the right decisions at the best times. So, how do stocks work? So, basically, what happens is that companies sell shares to raise money. Like I said before, this is a way for them to raise money to improve their company. And then that it, and can be used in a variety of ways. The companies can use them in a variety of ways, like I said before, with the products, manufacturing, inventory, stuff like that. The first issue stocks are through an IPO, initial public offering. I'll explain that later, just in just a few seconds or just a few minutes. Usually, when trading, you'll be buying from investors that want to sell or vice versa. So, unless it's a company that just starts off with an IPO, you're probably going to be you're not going to be directly involved in buying shares or stocks from the company. What you're probably going to do is that you're going to buy it from somebody that's already selling it, or you're going to sell it to somebody who's already buying it. Because once a company goes bigger and bigger, it it doesn't become the company's job to give out or sell stocks individually every single time. Next, we have trades are handled through the stock exchange. Like I said, the NYSE's New York Stock Exchange or NASDAQ or Dow, S&P 500, stuff like that. Investors can use stockbrokers to trade through. In this period of time, it used to not be like this, but this period of time, a lot of people are using stockbrokers. Stockbrokers are basically people that work the in between. So in between you and the company that you wanna, or the investor that you want to get that stock from, or you want to buy the stock from. So a lot of stockbrokers are the in between, and they try to find you the best deal possible, the best investor, and to buy from, the best company to invest in. Most of the time, they sometimes do charge a fee for doing this, but I'll put some links down below about for Ameritrade, Merrill Edge, and IBKR Lights. I'm pretty sure they don't. I know Ameritrade does not do don't do doesn't do many fees, but I'll put down in the links how much how much are the fees and stuff like that, or in the description. Sorry. So brokers can show you the best places to buy stocks from, like I said before, and you need to have a brokerage account to buy stocks. Basically, it's an account where you can go in, buy stocks, have everything in one place, The brokers can look at that as well and help you, because that's their platform. The brokerage account is their platform, and they're trying to help you be as successful as at investing as possible. So initial public offering. So remember when I talked about companies right when they first go public, right? There's these things called IPOs, the initial public offering. Basically, it's a launch party when a company goes public. They're basically giving, okay, so guys, we're going public. Here's the money that we're, or here are the stocks of the shares we're giving to you, how much we're selling. So a public company, of course, is a company that decides to offer shares to sell outside investors. A private company is all on your own. You're not public, so you're not letting other people come and ask or buy shares from you. So you can find upcoming IPOs on any of the major stock exchange websites. I'll have those two. I'll have the NYSE link in the description as well as the NASDAQ link in the description for the IPOs. Well, what does it mean to own stocks? So it's a weird question. So what does it mean? You're basically owning a part of the company. Some stocks can give you voting rights. If you invest a substantial amount in the company, you go onto, you're a part of the board. But sometimes you're just owning a share of the company's profits. That's essentially what it means. You're owning a share of the company's profits, and you're trying to make money. You're not really trying. Some people go in and try to invest all their money into one company so they can be part of the board in that company. But most of the time, you're just trying to invest to get more money. That's basically what it means to own a stock. So the risks involved. Like I said before, there are risks. Sometimes it's high risk, high reward. Sometimes low risk, high reward. Sometimes it's high risk, low reward. It just depends on how the market's doing that day, that month, that year, that week as well, and also outside influences. So, um, outside influences mean how the politically, what is the government doing? The tariffs on the different products, stuff like that. How are the people, demographics in in a developing country? Of course, the market's not going to be as well developed as in a developed country. As well as like diseases, stuff like that. It can really affect how the market's doing. And when it's a disease, people don't want to go outside. They're sick, so they don't want to buy. They're only going to buy essentials. Because of that, the market might go down. So you want to look at all those different types of indicators out in the real world. So a lot of this, like, you'll get smarter as you do this. As you get more experience with investing, but you're learning a lot more than just investing and putting money in. You're learning more about the world than most people are in their jobs. So with there are three main risks involved in investing in stocks. There are some more, but you kind of have to research more into them. I just want to give you an overview of risk. I might do a separate risks video over all investments, but for now, these are the three main risks for investing in stocks. So market risks, it means it cannot be eliminated. There will always be a market risk. That's also means it's a systematic risk. It can't be eliminated. So this is basically when factors affect the whole market. Example, 2020 coronavirus. Um, Basically, it stopped a lot of production in many countries because people were not buying a lot of the different goods, different pleasures that they usually buy, and they were buying more essential goods. So because of that, it affected a lot of the like theme park market, stuff like that. So like anything you do for fun affected a lot of that because people didn't want to go outside. Another one is inflation risk. Inflation basically means when you're paying for something, or you're buying something, but it won't be that same value in the future. And that's what it basically means. The cash flowing in today won't be as much as in the future. And example would be any of like the jewelry you get from like 1900s. It'll be worth either a lot more now, a lot less. It would have been a lot less in the back in the day, but now it's a lot more. That's where de-inflation. Inflation would mean, I don't know if there are any history nerds watching this, but silver in the 15th to 18th century, Spain went into South America, found a lot of silver, started distributing it all over the place, and then it started inflating so much. The price of silver was almost zero at that point because so many people had it, and so it doesn't really make any sense. That's the same thing with like dollar bills. If you have if a lot of people have dollar bills and cash money, that's why a lot of people didn't like cash money. Is that a lot of people have it? You could just keep printing it. The value of it in the world sense goes down. Liquidity risk basically means investments can't be bought and sold quickly. Many people don't do this. It's not a huge risk, but some people want to buy quickly and then sell it quickly so they can get that small jump each day. And it's only in some stocks, some investments. So types of stocks. This is the last slide. But we have 7 types of stocks. There are probably more. Common stock, I want to put that out there. Common stock is the most common stock. It's usually part of any company. But now we have blue chip stocks. Blue chip stocks are basically any company that you're getting shares from a large stable company that can continually profit, that you can continually profit from. So like Apple, it keeps going up little by little. Even if it goes down, it goes back up. You'll keep profiting. You'll eventually lose some, but you'll in the long run you will profit. Speculative stocks, I mean, anything that you think is going to be good. Speculative. That's what speculative means. Anything that you think can be good. But in the stock market sense, it's any startup companies with little data, little financial data, so you don't really know if they're going to do good or do bad in that market. So an example would be any startup that just goes public, first IPO, like I said before, initial public offering. Growth stocks are companies that I expect to have high earnings. This comes with a lot of risk because high reward, high risk. Tesla is a good one. It's shot up from December of 2019, the end of December 2019, to the end of January 2020. It shot up almost $600. Went from 240 to 860 per share, and that was a huge jump. But it's going down right now because of the coronavirus happening. Value stocks are stocks that investors see potential in. This means like anything that people think is gonna do better than it is doing right now. They believe in the value of the product. So Intel did do really good in the past, but they hit a little bit of a rough spot, especially with new products coming in that competed with them. But people still invest in Intel because they believe it's still gonna invest in their products and create new products and come out and beat those competitors. Income stocks are stocks that pay extremely high dividends. As I said before in my last video, dividends are income that you get from investing in a company. The company will give you a dividend. Basically, income means what money you get, and income stocks, a lot of people invest in those just to get that dividend, and that's a dividend investment stock. I think that's what it's called. Penny stocks. Penny stocks are low price stocks with high risks. So these companies have very, very low share prices, but they're high risk and they could potentially be high reward. You can buy a lot of them and eventually hit a really good amount. It could go from it goes as low as 2 cents to $5. Those are that range is what a penny stock is. Example would be Pier 1 Imports. It's 23 cents per share currently, and like I said, all stocks have risks, but penny stocks, speculative stocks, and maybe even growth stocks, I think have the most risk involved in them. Cyclical means dependent on the health of the economy. I think this is in general in any stock, but it affects more. Cyclical stocks are more affected by the health of the economy than any other stocks. So any car manufacturers or especially restaurants, 2020 coronavirus, or COVID-19, it affected greatly the restaurant business, the restaurant market. They started self-quarantine. They started doing self-quarantines, and they weren't able to go outside and enjoy luxury or pleasure in restaurants and stuff like that. And so the restaurant stock and the restaurant market kind of fell because of that. And so that's what it means dependent on the health of the economy. So please, if you have any questions, type them up in the comments. I'll be sure to answer them. I'll try to answer them. Um, so I'll put in some links down below. I think I said the Ameritrade, stuff like that, the brokerage accounts, the IPOs for the NYSE and the NASDAQ. I'll also put in a few book names, book titles that you should maybe read if you want to learn more about it, more than what I have to offer you. If you want to learn more, please read those books. That's where I get my information from. Later on, I'll put even more links down about certain websites that I use to go to. To see the stock market, as well as I'll try to make sure that you're prepared in any way possible for any outcome in the stock market. I'll try to. But thank you so much for watching. So make sure you subscribe to Course Hub. Make sure you go to the Course Hub page and look at other courses. We have many other courses. Please hit the bell icon for post notifications. Make sure you like the video and make sure you comment. Thank you so much for watching.